Paul, thank you for being here today and being a part of our speaker series with the leading, the thought leaders in the industry. I've known each other for a while. I have mad respect for that strategic, technical mind of yours, and also, frankly, where your heart is over the years as we've worked together. But before we jump into really highlighting the products and services that you're bringing to the market as an entrepreneur, I wanted to just share. We're asking all of our participants just to tell a little bit about your personal story. How did you get to this point in life professionally? It's always really interesting to see people's path to success. So yeah, if you wouldn't mind, just tell us a little bit about your history and how Paul Imura got to this point in his life.
Well, I was born in California many years ago, second generation Japanese American. English was the second language till I was about 3 years old because my mom was from Osaka. She would just speak Japanese to me as a kid, as a baby. So I ended up going to Cal Berkeley, as well as my three sisters and brothers. So I was one of a family of, Cal Bears. And I always thought I wanted to get into money management. So I graduated, went into international capital management, and I was in it for about 2 years. And I kind of fell into the mortgage world, and I saw a higher purpose, home ownership. And home ownership meant a lot to me because, and a lot of these stats, Henry, if you're a homeowner, the average net worth and as a homeowner in this country is $200,000, but if you're a renter, it's like $5,000.
Yeah.
And in addition to the economics, it creates a lot of stability. I grew up in a pretty rough part of California, but I found education as one of the equalizers. If you get a good education, they always teach you, well, go to college, you'll make more money, but no one ever tells you, buy a house, you'll have more wealth.
Yeah.
So I learned that at an early age. I thought, well, this is pretty cool. If I can build products, help innovate the first-time home buyer. And I spent the perspective of my earlier years as a student. Like I wanted to learn finance, technology, risk management. I spent time in 30 different countries. I covered Europe, South America, Asia on market development for AIG in the mortgage market. Launched programs to expand home ownership. Because what I found in visiting different countries is if you have a strong housing market, you have a strong economy. And everyone knows when you build a house in Charlotte, you're not outsourcing. You're hiring local people to build your house. You're creating tax revenue. You're creating jobs. And I think that perspective helped me realize that there's so much innovation that can be done in our industry because the byproduct is very good socially and economically. And like I said, it doesn't matter what your background is. If you have education and you have home ownership, those are the two great equalizers.
Was that drilled into you by your parents, or did you come to that by virtue of observing your family?
Mostly observing. I saw education because there was no choice. It was like, you're going to go to college. That was not a choice. But I'll share with you a personal story. 8 years old, my dad died. My mom had to raise 5 kids by herself. And fortunately, he had mortgage life insurance. So the house was paid for. So we owned a house. Nice. But it was our center of stability.
Yeah.
There was no moving to a different apartment every year, like some of my friends in grade school. And I just found it very comforting. So I didn't make that connection until later, until that $12,000 home is worth a lot more in California. Because the home that when we left California, back in the 90s, you can sell your house for $200,000. You think you did really well, but if you try to go back and buy it for $1.3 million, that same starter home, it's just crazy.
Now, did your dad, that product that he bought, that mortgage insurance product, just out of curiosity for our listeners, what was that product?
It was mortgage life insurance.
Okay.
It was because, in case anything happened to you, the mortgage is paid for.
So you're an entrepreneur now, again?
By choice, because I spent many years in big companies. I worked at AIG, I worked at GE, worked at Allstate, PMI. I worked at Accenture for a bit with you. I worked for a global FinTech 100, based in India on mortgage technology. And then All of a sudden I realized my kids are out of college, out of MBA school from Chapel Hill. It's like the risk profile changed. So now you're willing, I was willing to take on a little bit more risk, do something more interesting. I've innovated quite a bit for companies because I always see an opportunity, not just immediately, but 1 year, 2 years out. Because when Dodd-Frank passed, I was working on the first web-based compliance tool, and that was the Mortgage Technology Innovation of the Year. So a lot of times the market will make it obvious that there's a gap. But as an entrepreneur, I see lots of opportunities. Currently, a co-founder in a tech company, a builder marketing tech company, focused on new residential, and also a co-founder and chief innovation officer for a mortgage company called Home 123 Mortgage. And
let's start with the tech company. Tell us exactly what the brand is in the marketplace and what it does.
Well, it's called Proposed Properties. It was formed in 2017, and the concept is, you've heard of house staging, right? Like you're trying to sell a house, you'll stage a room so it's a bedroom, not a den. Well, we came up with the idea of virtual land staging, and a lot of people are surprised that there's 1 million open lots for sale in the country.
Interesting.
There's over 1 million teardowns, because the average age of a home is 37 years old, a lot older than that. So some older homes are primed for teardowns and rebuilds. And a lot of Freddie Mac studies show that we're about 2.5, 3 million short in inventory.
Yeah.
So that's why home prices keep going up.
Right.
And they're going up on the higher end, and that's creating more lack of access to housing.
Right.
So the concept is, if you can, and people are, our theory is people are visual people. If you take 2 lots, all you see is 2 lots of dirt.
Right.
But if you take a lot and put a virtual house on it, whether it's a real home builder design or a rendition or one of the 20,000 different home plans we have in our system, the consumer is all of a sudden empowered. So the realtor, who's a local market expert, can now take a look at that lot and say, okay, I know this market better than all the algorithms in the market. So I know that this is perfect for a 2-story home. So now with lot to home, we're able to switch out those plans such that the consumer is able to have more choice. And the fulfillment is with a network of contractors. It's about 175,000 across the country. And I picked them because I thought they had a smart way of filtering their contractors. There's 4 million in the country, but if you pick 175,000 with the profile based on 71 variables to score them, and this, Henry, you can get a distribution curve of the top 10 percentile of quality builders in Charlotte, for example, and say, okay, I'm comfortable with that set, comfortable with what products they have. And now I can visualize what that looks like. An agent value prop is, now I'm not just selling a lot, I'm selling a lot plus a home, which is statistically better, because when you bundle a lot in a home, the average asking price for the lot goes up from 80% to 92% based on MLS data.
That's extremely interesting to me. So let me just play this out of my head. So my wife and I are interested in buying a home in Chapel Hill.
Okay.
And we engage with a local realtor, and we look at physical properties, and we're like, maybe we're interested, maybe we're not. The realtor says, let me show you a piece of dirt.
Right.
And we go look at that piece of dirt, and I say, boy, I wonder what I would put there. And then the realtor says, I have a technology that can actually help you visualize exactly some alternatives that we could build on this very lot. Is that how that works?
Correct. That's correct, because then you as a consumer knows what you want. The realtor is empowered with different choices. There's a network of builders, because you buying in Chapel Hill, you're going to want to know that if you're out of town from Charlotte to Chapel Hill, 200 miles away, you're not going to know all the builders locally.
Right.
And you're going to want to have some basis of picking a builder with some objective scores.
Okay.
And that's part of our solution.
It's a fascinating model, Paul. Let me ask you a couple other technical questions on that, because it's really interesting. So from a technology standpoint, do I use when I go to that lot with the realtor? Are we broadcasting? Are we streaming it on an iPad? Are we do we have a big screen set up to really make it pop? How do you actually show it to them?
Well, the agent is the local market expert. So our technology puts the agent in the center because there's 1.4 million agents in the country.
Yep.
And a lot of technologies displaces the agent.
Yeah.
Ours embraces the agent as the local market expert.
Okay.
And this may surprise you, but I'm from the baby boomer generation, and they track how many baby boomers use an agent in their transaction. The number for millennials is actually higher than my generation.
Interesting.
By 2 points, which is pretty significant. So
right.
That local market expertise is still needed. So the agent is able to say, well, this property, I can put this rendition of virtual house there and sell it. And it works on not just the best lots, because what's interesting in our case studies, we had one lot seller, 2 lots that was trying to sell. Couldn't sell them for 8 years, no bites. The #1 real estate agent in our state turned it down, even though it would have been an easy listing to pick up. By putting the virtual design on it, it sold, both of them sold in 6 months.
Yeah.
And that's because consumers are visual.
Now, the inventory that your realtors are visualizing for these consumers, does it run the range from sort of entry level inventory right up to your super high custom design stuff?
It does. And it's not always the best lots, because they're the ones that sit there. So there's a lot of expired FSBOs, for sale by owner lots. And quite honestly, if you go to a lot seller and say, look, I want the right to market your property, I'm going to give you what you want as for your price point. And they have very little downside. So the conversion rate of these lot sellers into the program is pretty high, significantly high. And then it's a matter of fulfillment. So what I thought, if I'm building a company, I have to think about how to go broad.
Right.
Because they're going to say, you got a great idea, but how are you going to scale in Birmingham, Alabama?
Right.
Because I had that question from some industry leaders. It's like, I love your idea, but how are you going to take this broader? Well, by having strategic partnerships, because if you're a company that hires and hires, you have so much overhead that you just don't know if you're going to make money. But if you have partnerships with, like the one I have in California, Silicon Valley, that has 200 million building permit data, can build a scoring system on contractors and can give me a list of 57 builders in Birmingham to build these homes, and working with that subset to figure out what plans, because I have the combination of renditions to actual homes that are being built by builders today. And quite frankly, those are the best ones because there's no variation, right? If I have a builder on a lot who's done it 20 times, then they know what's it going to take. But if I have a rendition or a visual picture of what that looks like, then you're estimating, the actual cost, and you have to be pretty close. I traveled through the country, found a lot of agents weren't technically trained in new construction. Because they don't sell it. If you think about new construction building, it's very fragmented. You got 4 million contractors, a lot of smaller independent contractors. So I created this, was one of the founders of National Association of Independent Builders and Real Estate Services. And I call it neighbors, and when I looked at the ecosystem of, you've got all these builders, you've got all these real estate agents, and you have lenders that do the construction perm that understand the value proposition. Yeah. By bringing all of the parties, we can unify them into a group, we can educate them, and we can empower them with tools like Lot to Home and the one we're going to release going forward. But education is really key. So we've had students take the course, learn all the steps, get certified by a trade association, and be able to be supported in this new method of growing the business.
Who you are empowering with the technology. So you've clearly picked the realtors. Has there been any thought about getting this in the hands of distributed lenders who are self-generation loan officers who have a client database and might point a consumer to a lot they might not otherwise, think imagine of funding?
We have, and some of our lending partners specialize in construction and perm, because as you know, not every lender does construction and perm.
Right.
Even the biggest ones are stayed away from it. I think for them it's a natural fit because they've already have an alignment with the realtors. So it's a great way to manufacture demand for the product, because statistically 1 out of 10 consumers actually build a house. But the studies have shown 6 out of 10 are interested in building a new house. So if you're a consumer, it's like, I would love to get a new house, but I'm not going to do it because no one's leading me through that or navigating through that daunting process.
Sure.
And by education, by partnership, by aligning the interest, you're solving for all the positive value proposition points to make everyone want to work towards the same goal.
You know, we are very interested in how technology can bring, or at least close the gap on the home ownership opportunity. You described in your own personal background how important home ownership was to your family stability. How many of these lots are concentrated in areas of low to moderate income folks where this might be a key to success?
Well, I think that the in-lots vary. In-lots are, you know, like you live in a neighborhood, there could be a vacant lot in between two houses, and a lot of people don't even notice it because they think it's just an extension of the two homes that bookended. I think that a lot of municipalities, land banks, land investors have, you know, like more than adequate number of lots that could be built for affordable housing, starter homes, that entry point. Because right now, the economics of, if you're a builder or even a mortgage lender, you'd want to lend big, you know, outside of the jumbo space, right?
Yeah.
Or you want to build as big as you can for the margin. And a builder would say, I'd rather build a $900,000 home than a $300,000 home. But if that builder was presented an option on 10 $300,000 homes, then they've got the economies of scale of the different stage of the build. And where this can address some of the challenges in the market from access for that affordable space would be the wholesale model of going to a city, going to a municipality, going to a land investor and say, okay, I want to build 1,000 homes, and we'll do it in phases. And we'll take a lot of the risk out, because what I described to you, a lot of builders don't have to invest in buying the lot, building the house. It's speculative. Pre-selling, it takes all the speculation out.
Right.
And I've got an idea around anchoring these communities. And I'll give you an example. Like, there's over 20 million veterans, military veterans in the country. And most people don't, well, they represent about 7% of the adult population. But a NAR study shows that there are 1 in 5 real estate transactions it's a former veteran. That actually surprised me.
Yeah.
So one thought is, if we can, and they have housing needs just as, you know, as much, if not more, and they're not going to be in the market for the $900,000 home. They're going to be in the market for, you know, something more reasonable that kind of fits that starter home. You know, a couple years out of college, maybe 5 years out of school. You know, I need a $300,000 home, not a, you know, $1.5 million. Right. Those homes, those developments can convert unused land into tax generating revenue for the cities. And now you've got a design that gets people wanting to go into an area. And I'm not suggesting, by no means, like, make it all flat in terms of, like, I don't want to build a project. I want to build a community that goes into different levels of 300, 400, 500. So there's got to be an example of someone growing out of that starter home.
Have you been approached by any of the online realtor firms like Open Door, or, you know, some of those more digital marketing firms, be an interesting model for them?
I think that what we've done is more of a grassroots, you know, grow it, test it, and you have to refine a business model when you launch it. So we went in Chicago, toughest market in the country. There's lots of headlines that say it's a really tough market. Those are the ones that, you know, in the course of a year, if we have 150 million consumer, you know, $150 million worth of consumer interest in building, that's a good validation of extrapolating that to like where we're at in North Carolina and Massachusetts and Connecticut, and we're going to go in Texas and Florida, and not every market has the lots. Like if you go to San Francisco, you're not going to find a lot of open lots. It just doesn't exist. But if you go to Texas, you can find a ton of them, or Florida, you can find a ton of them, or in North Carolina, there's 70,000 lots. I mean, there's tremendous opportunity. So I think it addresses the footprint coverage works well for affordable housing. In 2005, I was one of the few people that started the first mortgage diversity conference in the industry. It was 200 lenders. It was the head of Fannie and Freddie. We had everyone in DC talking about the issues of inequality, why homeownership rates are different for different backgrounds, and what do we do about it as an industry? What's it going to take? And I did a pitch on the good, the bad, the ugly of mortgage products, because back in 2005, I was like, I described some of these products coming out can have a 70% payment shock. And I had one of them working at a very big company. And I knew my payment shock would be 70%, but my DTI was 10% to begin with. So 17% DTI for me was, as a third-time home buyer, not scary. But what if I was a first-time home buyer? Am I going to get a 15% raise per year in that environment? The odds are no. I'm going to be stretched, and the math didn't work out.
Right.
So there's this category of products that I saw as difficult and challenging, and it's just a ticking bomb.
That payment shock points to, I think, a little bit of a question around, particularly maybe for low to moderate income folks or first-time home buyers, or maybe perhaps even millennials who have limited literacy around this issue. Perhaps a knowledge gap around what the economics of home ownership really mean. Just because someone puts on paper that you make $10 and boy, this payment's only going to be $3.50 of that 10. You can do this.
Right.
It doesn't necessarily factor into a realistic cash flow analysis. You've been all around the block on this. What are your thoughts about how we maybe need to address this education gap?
I think that it's going to be critical to mitigate the next wave of mortgage losses or housing loss, because a lot of consumers do not know that their mortgage will adjust to that level of pain. And the non-QM market before was just huge. I think it was like 50% of the entire country. And if you lived in California, 80% of the state was non-QM, because you needed interest only, you needed option arm, you needed extended term, you needed short-term arms just to qualify. I view risk in terms of layers. So you can stack risk or destack risk. So that was the great learning from that time, was I can categorize it as QM and non-QM based on the attributes of what the structure was. So a lot of times I think it's just bad product, bad matching. The matching is bad. Like the
matching is bad. So, one would argue that in 2008, it was an issue of an oversupply of liquidity, perhaps because of flexible lending standards, which gave rise to home value inflation simply because it allowed folks to compete. And with more competition drove more price inflation, and you fill in the blanks from there. In the current market, there's a sense that there's an inventory shortage, and but there is still ample liquidity, but not the same type of liquidity products we had before. Fannie and Freddie, that the paper that's being written in the marketplace today is relatively very low risk and very conservative, but it's really an inventory issue. So I'll ask you, do you think loan officers today have changed their behaviors in terms of the perhaps artificial incentive to match a consumer to, let's match them to as much as they can afford, because frankly, the commissions will be bigger. The lender wins, the lender makes more money on larger balance loans, et cetera. Or do you see that not as much of an issue as it was maybe a decade ago?
I don't see it as much as an issue as a decade ago, because I think a lot of MLOs see a fiduciary responsibility of what they're, their customers are placing that in them. So there's an obligation to do the right product matching. And it's not always the highest rate, highest commission, because, that's pretty well known. That's not a acceptable practice. I think the liquidity is very different today, and we're seeing that in the form of very low interest rates that we would have never predicted. I mean, this pandemic, the $40 billion a month, Fed purchasing of mortgage debt has just driven rates way down. And it's been a race to refi and a race to buy.
Right.
So even with the latest census data, I mean, some of these different, homeownership rates ticked up, because it's kind of a, if you think about what we've experienced as a country of losing 40 million jobs, and, it's just crazy.
So in your experience with what we're seeing right now, since we did lose 40 million jobs, and theoretically that disqualifies a large number of people to either refi when they're not employed, or even step into a new home unless they have just incredible savings. But even then, an unemployed person typically has a hard time securing.
Right.
So it's sort of this same cohort of people that are either stepping up or refining, right?
Correct.
In the market. What is the responsibility of a lender to not only use technology to match a borrower to a qualifying product, but maybe to help them understand cash flow and payment shock and home affordability management and the other responsibilities that come with home ownership? Is that really an individual's responsibility to know before you owe, or is there a fiduciary responsibility, in your opinion, for lenders to use technology to help consumers figure that out?
I think it's the lender's responsibility to convey that to the consumer, to be able to show this is what's going to happen, your total payments, what you're going to pay in terms of percentage of interest of your principal. I mean, all those factors are designed as guardrails for making bad decisions. And regulation, I mean, there could be a tremendous amount of compliance, but if the intent is followed by an efficient form, then everyone wins. And I think consumers today need to understand that, this is what they're in for. And even though home prices have done extremely well, that's not a guarantee, because through the cycles we've seen,
Sure,
markets go down pretty quickly.
Yep.
California is a great example of, you buy a home in the early 90s, by the mid 90s, you're regretting, why did I buy it? And 20 years later, you're thinking, why did I sell it?
Now that you're in the business and you're trying to use technology to actually fulfill loans, what's keeping you up at night about the technology that you use? What's got you excited about the technology you're using as a lender? And have you done anything creative since you got in the space?
I think, those are great questions. We're a lender in 14 states. We have a LOS system. We have, components that are outsourced for, doc closings. It's pretty straightforward, where the customization of the technologies around what products do we offer.
Okay.
And how does that fit well all the compliances? Because, if you're a single state lender, it's pretty straightforward, right? If we're in North Carolina, we know what North Carolina looks like. But what if you're lending in, 13 other states, and making sure your rules are in place to ensure compliance?
So you built your own product rules engine?
It's been customized, but it's basically Encompass. Our company philosophy is, we got to have the technology scale to the business needs of the short term,
Right.
and plan for enough long-term exit into something different if we need to.
As a lender of your size, right behind Wells Fargo, I understand, in total. Could it be that SaaS-based technologies, right, easy to turn on and off, are frankly good enough? And this constant, in our industry, we constantly are hearing about the need to go to AI and digitization and advanced technologies for competitive edge. But you're a lender today, and it sounds like you're using a lot of third-party SaaS-based products, and life is okay. Is that a fair statement?
Life is okay, because processing loans is by design very step-like workflow. I think where the technology for us, it enables our products and services, whereas as a lender, it's tough to be vanilla. And Home 123 Mortgage, the company, I'm one of the founders, has to have the ability to offer products that are not in the view of some of the bigger competitors. Home improvement. Home improvement's a great example. I mean, that's just a giant market. And as people were staying home for the last couple months, they're looking around their housing and all the things they have to change and fix, and the list starts growing. And that renovation piece is going to grow on multiple fronts, not only on the construction side, but also on the financing side, because most people can't finance a $25,000 project. They need financing, and the lending environment's been conservative. Like if you try to get a HELOC above a 95 LTV, it's going to be tough. But can you get a home improvement loan that's FHA guaranteed, that enables affordable payment to that consumer that's going to sell their home? And I've talked to a lot of realtors about what we built was called Dream Builder, because a lot of people go into homes thinking, well, I don't like this kitchen, so one of the spouses will say next house, and the realtor's taking the next house and the next house. But if they knew that they have an option to say, you can change out your kitchen in 3 months, we pre-qualify you for that. Let's use VA as an example, right? VA loans, you're not putting any money. It's like virtually no equity, close to 100 LTV, but you can still get a $25,000 FHA guaranteed loan.
Interesting.
Assuming that it fits within the DTI. So there's a lot of products, and I think that's where the big exciting opportunity from innovation, because I see innovation on two fronts. One is on what kind of products can we launch that couple with other technologies, because I view technology as enabling change. It's a catalyst, and being able to say, okay, now I can engage the consumer better. So if it's consumer centric, then I see a lot of opportunity.
How much does alternative credit scoring come into play when it comes to trying to help folks qualify or take advantage of products? Recently, you talked about renovations. I was just in the market myself to finance a fairly major renovation of my home in Charlotte. And really what it came down to was I was trying to do something fairly creative, and I was really stuck with, to be honest with you, a home equity loan of sorts, capped at an LTV, so forth and so on. And they didn't take into consideration any of maybe my unique circumstances to try to work with me. There just really weren't very many options. What are your thoughts about alternative credit risk modeling, credit risk scoring based on the individual's unique circumstances?
That topic has not been. That's not a new topic. That's been around for many years in terms of the underbanked, the thin file. How do I get that credit score? And I think it's going to ultimately emerge, but I think that the underwriting guidelines are going to reflect the tolerance for that. Like the example I gave you, an 80-year-old product that FHA has, no equity required. There's no appraisal required. See, that's alternative to what most consumers would even know about.
I want to go back to your meeting in 2005 in DC with all of the stakeholders that you brought together to talk about closing home. What was your conclusion after all those meetings and briefings and think tanks? What did you guys conclude was the roadmap forward? That's 15 years ago.
That was 15 years ago, and I think one of the conclusions was, I had to set expectations. Having the discussion, dialogue, was positive. For the first time, bringing the heads of different NAROB and NAREP, Hispanic and Asian together on a platform to talk about what are the challenges in home ownership. I think that dialogue was useful in getting people aware that it's not just a painful reminder of, we're not addressing this, but it's a hidden opportunity for the industry to make more money, because you can do well by doing good, which is closing that gap. Second thing was, one of the conclusions was risk. You can't assume that it's a normal distribution curve. That I always believed in the black swan theory of something bad can happen that you never expected. And back in that time frame, everyone thought home prices would continue to rise. I believe that what we're seeing this year is a reflection of, you have to be aware that in the future, we will see events that are going to be so shocking and surprising in our market. Like, who would have predicted in their model, mortgage interest rates in the twos, or oil prices hitting zero and negative in a day?
As we work with a lot of big data concepts, there are tons of public data stores on micro and macroeconomic data, but what we're seeing now is truly an anomaly, because it's quantitative easing supported by federal government decisions, and you can't anticipate whether they will or they won't. You don't even know who the administration is going to be 4 years from now. So if you're looking at prepayment speeds at 7 years, 7.5 years, or at least that's what you're modeling, I suppose you can make some basic assumptions based on economic trend data, but I don't know that 7 years ago anybody would have thought this is where we would be, right?
Correct. That when you look at the unemployment data, the charts, and I just recently had a session with Freddie Mac's economist, one of their senior economists, about how that was a 30 sigma event. And 30 sigma. And, Henry, I know you're familiar with Six Sigma because I think you're, certified. And I just remember Six Sigma was 3.4 errors per million.
Right.
And 30 Sigma is just mind-boggling.
It is by definition what you would call an anomaly. What do you think about, while we're on the topic of economics, because I think it plays into predicting how much demand will there exist at a 4% note, right? Right now we're at, the low threes, I guess, right at 3. But, a lot of folks say, well, what happens when rates go to, 4, 4.5 to try to create yield to stimulate the markets, right? Or to curb inflation. And now you have those 40 million people who are laid off, right? I saw a report yesterday in The Economist where one of the fiduciary offices, Department of Labor, that is actually sort of objective these days, said that, you can quote the unemployment rate right now at just shy of double digits, 8.5%, 9%. But the actual, the normative unemployment rate, if you take into effect not only people who filed for unemployment and looking, but people who just sort of given up because they don't fit into the job market anymore, or those individuals that are in fact working and therefore not collecting, so they're off the books, but they don't make enough to be above the poverty line or within one standard deviation of the poverty line. That number they estimate at 23 to 24% of the total population, which was mind-boggling to me. So when I look at that number, I mean, it's sort of, I'd love your take on this. Are you bullish or bearish on what the industry demand will be at, say, a 4% note with these economic realities?
Well, let's take it one step at a time. The 4% in relative terms is pretty reasonable in the long term.
Sure.
Because I remember 8% was considered a good rate. So that doesn't scare me, because the consumer dynamics of household formation and people wanting to get homes, I mean, it is a desired state in our country, right? Whether you're a 6% environment, people are still buying homes. There's a gap. New construction for the last 8 years have not outstripped household formation. So that gap's always been there. So in my mind, a lot of this is supply and demand. So rates going up doesn't scare me. I think housing's still preferred. I think the big test was the last housing recession, where people were saying, do I really want to buy a house? And it's a falling knife. And it turned out not to be, because a lot of the markets did recover. A lot of it did prove the case to be a wealth builder over time.
Yeah.
So I'm more bullish, because I think that we're going to see, especially as the millennial population grows up and grows older and gets into the, home needed times of their lives, having kids.
Yep.
It's hard to imagine. I think you could be 40 years old and be considered a millennial now.
Yeah.
That's all shifted. So
well, you and I, we're just right on the cusp, man. We're just right there.
I called myself a double millennial at one of these events because, doesn't matter if you're, a baby boomer, you can still have the energy of two millennials.
There you go.
So no, I think I'm bullish because I think the demand is there and it's a proven, home ownership has been proven over the ages that it's a good home. The definition of home has changed. Home used to be where you go home to after work. Now home is where you get your shelter, you get your school. Now with a lot of kids, you get your office there too. And a lot of architects are looking at two office designs in their new home construction models.
Yeah, interesting. You were the director of strategy for Accenture's global credit services offering back in, I guess that was 2012 to 2014, or in that range. You led a global delivery organization and technology organization for a number of years. So my question to you is, we obviously are asking you to do this from the perspective of Infosys as a global technology services business. We have some appetite to build things that are relevant to our customers. So one of the questions we're asking all of our guests is, if capital was available and capital was not a constraint, right? So proportion wasn't a constraint. What would you advise a company like us if we were going to actually try to build something that was relevant to satisfying unmet industry needs? And we could build anything, right? Whether that's point of sale, LOS. What would you, as a strategic advisor, coach us to look at? Where should we be thinking about putting both capital and brain power in the marketplace?
I think given Infosys's size and culture of innovation and knowledge sharing, like you're doing with this fireside chat with your contacts in the industry, I think that there's a huge opportunity for innovation versus invention. I personally like innovation more than invention, because then I'm improving something. There's a big difference. Two, okay. I like innovation in a more practical application. Okay. And a lot of companies do what's called an innovation lab, but it tends to be separate, the think tank, internal think tank. Yeah. I would invest money into more of an ecosystem innovation lab, drawing in people of different parts of the organization, because the things you mentioned, you may recruit members to be, LOS specialists or servicing specialists or all the components of the process that's tech laden, or you can bring in thought leaders and innovators and engineers and saying, what's the problem? What do we solve for? How do we re-engineer it such that we can cut out costs, increase, all the KPIs of what's important, and that way you have both a market validation, customer validation. There's a lot of companies I find try to innovate in a vacuum, and that rarely works. You need a voice of customer, voice of market, and I think with the fact that your company has, I think, twice the market cap of Ford Motor Company. Infosys is a giant organization with hundreds of thousands of employees. You're not that far off from saying that you have that capital. I think, how do you engage the industry you're tackling? Because then it gets back to my comment of strategic partnership. Do you have groups within there that says, okay, I'm not going to go build 100,000 network of realtors that are really producing. I'm going to have that part of my ecosystem lab. And I take it not just the process, but both outside and the post process of like, okay, if I'm going to innovate the mortgage industry, it can't just be, from app to secondary marketing. It's got to be from, consumer to that whole process of lead generation, the process of getting, qualified. And, it's a bigger spectrum is my suspicion.
Than just the transactional part of it.
Correct. And that gets you into a relationship, role as trusted advisor.
Yeah. So, well, I think we're going to borrow that one, if you don't mind.
No worries. I just feel honored you contacted me to be part of this, and I was excited about sharing ideas and points of view. So this was really a lot of fun.
Mad respect for you. Everything that you've accomplished, the integrity with which you approach your work is certainly something I've respected for a long time.
Well, thank you very much, Henry, and to your team for making this a really cool process.
All right, brother. Thank you so much.
You take care. Take care.
Appreciate it, man. Bye-bye.